Thank you, Sarah, and welcome to our Fireside chat. My name is Sven Wagenknecht, Editor-in-Chief at BTC ECHO, and I'm delighted now to have Shannon Kurtas from Kraken Institutional with me to discuss the growing role of derivatives in the crypto sector. No longer a niche product, they are drivers of liquidity, market efficiency, and risk management. And with this rising institutional adoption and evolving regulations, their influence continues to expand, making this a crucial topic for the crypto adoption. And that's why I am quite curious and really looking forward to our fireside chat. But before we dive into the discussion, Shannon, I would like to ask you to introduce you briefly and maybe tell us what brought you into the crypto derivatives market.
Sure, thanks, Sven. So I'm Shannon Kurtas. I am head of the exchange at Kraken, so I lead our exchange businesses in terms of spot margin and derivatives trading globally. I've been at the company for roughly 5 years. My entry into crypto actually was in 2017, roughly. I had previously been a interest rate options trader at Deutsche Bank, actually. And through a series of quantitative easing, volatility of interest rates went far down, became quite boring, and so I found the next massive volatile asset, which is crypto.
Thanks. And historically, spot markets have dominated the crypto market. This is changing now a little bit. We see huge investments into the crypto derivatives sector. Just a few days ago, Kraken announced the acquisition of NinjaTrader, a futures trading platform. So what is changing now? Why are players like you are so interested into the crypto derivatives market?
So I'd say a couple things. So first of all, for us, this is not a new endeavor. We kind of entered the derivatives market in crypto in 2019 through the acquisition of crypto facilities in the UK, which was kind of the first regulated crypto venue, I believe, globally. And we think, a couple kind of core theses. So one, the development of derivatives in crypto is not going to differ dramatically from what we saw in traditional markets, in that eventually, if not already, the volumes in derivatives will kind of be multiples of orders of magnitude more than the underlying spot market. And there's kind of various reasons for that in terms of the participants and capital efficiency and so on. And two, we think that, broadly speaking, the kind of participants and competition between quote-unquote traditional markets and crypto will kind of converge over time, and that's likely to happen first and foremost within derivatives, where there's kind of less need to touch the underlying cash asset.
And when we look at the European crypto derivatives market, where would you or can you compare the European market to Asia and the US? So where do we stand? Where does Europe stand in comparison to them in the crypto derivatives market?
So I would say a couple of things. So first is to have a kind of fully functioning and efficient derivatives market, you need a fully functioning and liquid spot market. Europe was actually one of the first places to have any sort of exchange-traded products in crypto. I think 2015 was the first one by CoinShares. And so it's kind of been leading the charge in many respects versus regulated products in the US and Asia. In the US, of course, up until recently, there's been a lot of uncertainty in terms of the regulation around touching cash crypto. And so banks and corporates in the US couldn't have cash on their balance sheet for regulatory reasons and for accounting reasons. That's shifting a bit, but that's kind of one fundamental driver behind the efficiency of derivatives in Europe. And many folks, those who have been in the market from a kind of regulated bank and company point of view in the US, have only been using derivatives because that allows them to just collateralize with cash without touching the cash asset and worrying about custody.
And is there any impact from the MiCA regulation? I mean, when we talk about derivatives, it's more MiFID license we need for traditional financial products, but do you see also a change because of the new regulation in Europe?
Yes, definitely a driver, and further to that point on kind of regulatory clarity. Of course, MiCA is coming into force, as we speak, but there has been, even up until now, a patchwork, but more clear regulation for individual countries under the VASP regime that has made it easier for a wider variety of institutions and clients to hold crypto. MiFID, of course, is a very clear regulation, regardless of the underlying asset. And so with these two kind of bodies of regulation, it's very clear and helpful for European asset managers, trading firms, et cetera, to enter the space. In the US, that's like evolving quite quickly, but still nowhere near as clear and certain going forward in terms of who the regulators are, what the rules are, and how they apply to different classes of underlying digital assets.
Talking about the regulatory perspective now, are there any things that concerns you the most right now, there where you see the crypto derivatives market in danger?
I think uncertainty is the biggest issue when it comes to regulation in terms of protecting client assets, certainty around what will be done with particular client positions and margin and collateral in any sort of stressed scenario. I think there are certain unknowns still in terms of like a wide variety of crypto assets and how they'll be classified and regulated. Stablecoin is one example in terms of Tether being used heavily as collateral for derivatives offshore and being essentially outlawed in Europe. And so I think to the extent that regulation impacts particular assets for use as collateral, that is one major risk.
I would now like to talk a little bit more about the market itself and the customer preferences. Which derivatives are now, well, where you can see a high demand right now? Which product categories? Is it futures, options, other leverage products? I don't know. Can you tell us more about the demand right now there?
Yeah, so we kind of see it as building blocks for increasingly complex instruments and trading instruments. So first and foremost, you need an underlying cash market that is liquid and regulated. Two, then once you have a clear liquid cash market and a efficient lending market, financing, repo, and so on, you can thereafter have efficient pricing for futures and swaps. Once you have that, then you can kind of build on top of that options, structured products, and so on and so forth. So I think kind of perpetual futures, CFDs, and fixed maturity contracts, these are like the most liquid at the moment. They already kind of trade multiples of volume versus the underlying spot markets. But increasingly, now that we have futures, CFDs, ETFs in the US and ETPs in Europe, the question that many are asking is, okay, well, who cares? Like, what's the point? What's the best instrument for getting a return or even tracking like the broader market? And so derivatives will be key for structured products and like smart beta instruments that basically give you access to the underlying Bitcoin return, for instance, but with added yield on top of that. So I think options embedded in products like that will be kind of fundamental for asset managers trying to attract investors to Delta One or kind of smart beta products.
I mean, crypto is more volatile than any other major asset class. But what role does leverage still play in this environment? I mean, do we need a leverage, or does it make sense for hedging, or is it just speculation?
I think, yeah, leverage sounds like a bit of a dirty word, but it's kind of critical for getting short access, hedging risk, being more capital efficient. So, of course, there are a number of platforms and companies in Europe who provide crypto access to their own clients, N26, Revolut, the list goes on. And for them, being capital efficient, making the most use of their balance sheet, relies heavily on the use of derivatives for offering these products rather than having to worry about the spot assets in all cases. There are kind of a lot of headline figures on some platforms around the maximum leverage possible 20x, 100x, which is largely kind of a marketing ploy in many cases. We see that the vast majority of clients use quite conservative levels of leverage, and so it's an important aspect of the market. Of course, it is a volatile asset, but that risk can be managed in a similar way to other asset classes. There's nothing kind of novel about crypto in that sense.
So Shannon, you are working at Kraken Institutional, but I would like to know how relevant are the needs of the retail investors compared to the institutional? Or do they play a role, or do you just focus on the institutional side?
So we focus on both, and so the way we think about it is there's increased competition for the end investor, the end client. And so I think what's particularly the case with the crypto market, platforms such as ours, we target both the end investor directly and the end investor via other intermediaries and institutions. And so other platforms, regional exchanges rely on us, for instance, for their own liquidity and for their product. And so we kind of see it as serving the end client, be that an individual or a buy-side institution, as kind of two sides of the same coin, regardless of whether they're onboarding with us directly or whether they're indirectly accessing our liquidity, custody, and so on.
And how do you assess the competitive landscape for crypto derivatives? I mean, there are major traditional exchanges also stepping into the market, so not only crypto native players like you. Will they maybe take the lead at some point because they are bigger, or how do you assess this landscape?
Yeah, it's certainly a good question. We kind of see this playing out in potentially one of a few different ways. So because of this dynamic where you have both, you have platforms with both direct end client access, or more direct access, I should say, and indirect through the usual set of brokers and clearing firms. I think like one question fundamentally will be how much of the access in the end is through the same kind of central clearing firms and brokers, prime brokers, and kind of centrally cleared platforms like CME and Eurex be in the end. CME has grown dramatically in the past year or so, particularly with the issuance of the ETFs in the US, whereas Eurex has had crypto derivatives for a number of years and has seen like very, very little volume and uptake. There are also some kind of upstart crypto derivative platforms in the UK and EU who are regulated, centrally cleared, but have found it very difficult to kind of kickstart the retail demand and institutional liquidity because the end client demand is not going through them. And so really it comes back to targeting the end investor specifically, and there being kind of more compelling reasons for that investor to trade through crypto native platforms. That's kind of broader variety of underlying assets, broader types of collateral they can post to trade those instruments, and kind of value propositions that the traditional venues and brokers would be slower to implement, if at all.
I would now like to talk a bit more the technology side. I mean, we have new opportunities with blockchain technology. We're seeing decentralized derivative protocols are gaining traction. How do you assess this kind of new developments? Is it, how can they gain more, let's say they market shares also as a competitor, the decentralized protocols with their derivatives, or where do you see the intersection between the centralized exchanges and centralized derivatives compared to decentralized options?
Yeah, it's a great question, and probably one of the least clear in terms of how things will play out over time. I think there is a lot of innovation that is happening and can happen on decentralized platforms in terms of the pace at which they develop. Of course, regulation is a big question. We kind of see ourselves as a company as like a bridge to those opportunities in some cases, but in a regulated fashion where the client onboards with us, so they're fully KYC'd and so on. Conversely, like there are risks with DeFi. For instance, just the security of the protocols involved, the fact that there's kind of no recourse should your funds be lost for any reason. There's kind of a number of risks when it comes to on-chain market manipulation, quite frankly. And there's an opportunity, I think, in that going forward for regulators, in that if there is a kind of public blockchain or kind of private blockchain amongst a consortium of institutions, regulators might find it actually useful for monitoring systemic risk in a kind of a transparent, efficient way compared to traditional derivatives. But yeah, I think regulation is the key question when it comes to DeFi.
Okay, so centralized exchanges are better in terms of regulatory aspects, security, also liquidity, or how you assess this point?
Yeah, liquidity is a massive factor, and not just the liquidity of trading, but the efficiency of getting money in and out of the platform and it being the capital being more easily deployed elsewhere. So there, yeah, we're kind of watching the space closely. There are a number of platforms, DYDX, Hyperliquid, and so on, that have been trading quite material volumes on their perpetual contracts. But really, the question is who are they serving, through which kind of entities globally, and how are these companies regulated? That's kind of the biggest question mark in terms of how sustainable that volume is.
And how relevant will blockchain become, if it's about issuing and settlement derivatives? So is this maybe the infrastructure for the future where everything is happening on a public blockchain, or do you think it will stay within the traditional infrastructure for many years now?
I think we're more likely to see in the near term, on-chain issuance of stable coins and tokenized funds and assets that can be used as collateral for derivatives trading. I think it's probably less clear or kind of further out when it comes to any sort of issuance of derivatives or trading of derivatives on the blockchain in a kind of material, global, scalable way.
And how realistic is the scenario in the near-term future of tokenized derivatives for tokenized real-world assets, such as securities, for example, so that everything is tokenized, and you also have derivatives on real-world assets. So what do you think about that?
So I think we're kind of facing a similar question when it comes to equities. So equities, of course, one can trade true equities. One can now trade tokenized equities in various forms. And I think the question is, okay, well, who cares? When and where are the tokenized form more useful? And it's a kind of a chicken and egg and cold start problem, because it's most useful when those assets in tokenized form can be used as collateral and settlement for other activity bilaterally or on other centralized exchanges and platforms. And for that to happen, those particular issuers need to reach sufficient scale for that to be the case. And so for tokenized money market funds at the moment, the main use case of those at the moment is buying and holding and earning the yield embedded in those products, either indirectly or natively on-chain. Whereas the use of those instruments, those money market funds in tokenized format for collateral purposes is actually still quite limited. There's Hashnode being used on Deribit. Some of the under products are being used to an increasing degree, but it's still quite nascent.
Coming to the end slowly, I would like to ask you for an outlook. If you had to place a bet on the crypto derivative market in 5 years from now, what would your scenario look like? So what do you think where we are in 5 years from now?
Yeah. So I would expect the derivatives market to continue to outpace the growth in the underlying spot market and to look much more like traditional products in that sense. Two, that the regulatory clarity in particularly Europe, will lead to a further proliferation of exchange-traded products beyond just like Delta One products, so structured notes and enhanced smart beta products. And that there will be three kind of coexistence of kind of centrally cleared traditional venues who are targeting institutions that are trading with the same parties and in the same way that they're used to, alongside more direct market access for end retail clients and buy-side institutions.
Okay, great outlook. Thanks for your valuable insights, Shannon. And that brings us to the end to our fireside chat here. I think we are still at the very beginning of this adoption. I'm looking forward to further adoption, of course, and I'm very optimistic for that. So thanks a lot, Shannon. Looking forward.
Thank you.